What's up, YouTube? I'm going to walk you through how to read a 10Q. These are released by companies every couple months, every 3 months actually to be exact. And this one was filed by Under Armour on November 2nd, 2016. So we use them today as our example. Here's the front page. Typically has the company name here. The other interesting thing here is down at the bottom here, we have the total number of shares outstanding. And so this might be useful information to you right here on page number 1. Typically, there's an index here, so you can click to find different sections once you start knowing which sections to go to. What I like about these 10Qs is right off the bat, typically with these larger companies, maybe with a smaller company, they'll start off with a lot of text. But typically with these larger companies, they get right into the balance sheet and different kind of financial documents. And so that's typically what you're going to use these 10Q documents for. The first sheet here is a balance sheet from Under Armour, and we notice that it's through September 30th, 2016. This is for 3 months of sales for them. They also show you what their balance was, and all these figures were back on December 31st, 2015. Not all companies do this, but it kind of gives you a starting point, it looks like. And then finally, Under Armour gives you the year prior. So this was the 3 months ended September 30th, 2015. So you can kind of compare year over year, and then also Under Armour is allowing you kind of compare from the beginning of the year to where they are now. So this first line here is this cash and cash equivalents line. So we notice that it's this 179 million. Again, these numbers are in thousands. And so when you see a number like this, it's not 179,954. It's 179 million and change. And so you notice at the beginning of the year, Under Armour had a little less cash. And then this time last year, they had a little less cash too. But all in all, Under Armour has a fair number of cash. The second line is this accounts receivable. Now, what you will see, I'm going to bring up a separate company's 10Q here. Notice this company has cash and cash equivalents here on this line, but then they also have these marketable securities. You'll sometimes see this with companies, maybe not as much in a low interest rate environment, but I can imagine as interest rates tick up, companies aren't just going to be holding cash, just kind of earning nothing or almost nothing. These marketable securities might end up becoming 5, 6, 7, 8% interest. You never know where interest rates might go. But just to give you an idea, these are both I would consider cash. It's just Under Armour doesn't break this out, or they don't have any marketable securities. I just wanted to show you, you might see on another company's 10Q that they have these marketable securities. That's technically cash as well. Just kind of wanted to point that out. Next thing is accounts receivable. This is money that is owed to Under Armour. So technically, typically in Under Armour's situation, probably from like stores. So like Dick's Sporting Goods and those kind of companies might owe them money for inventory. Now this number could become in play when like Sports Authority just went bankrupt. So I'm sure they owed Under Armour some money. And if they go into bankruptcy, how much of this is receivable? That's why you can't look at this. This is $713 million. Now, if Under Armour collects 100% of that, that's great. But I can imagine there will be some write-offs on this line. That's in part why they break it out. But it also means this is money that they're going to receive in the future, or is scheduled to receive. Inventory. This is really important for a company like Under Armour because they essentially manufacture goods. And this is the September 2016 quarter. So we notice inventory is close to $1 billion, and that's certainly higher than the beginning of the year. And it is a little bit higher than the same period back in 2015. Now, for Under Armour, it all depends on the period. I would fully expect Under Armour to have some of the highest inventory levels right around this September quarter, likely because the fourth quarter is coming. And in the United States and around the world, that's a big holiday giving Christmas season. And so Under Armour's likely building up inventory here on this line, And they're hoping to turn this into cash and sales, obviously, during the next couple months and into the beginning of the year. They have some prepaid expenses. You might say, hey, why is a prepaid expense an asset? Well, this might be, they're prepaying leases, they're prepaying vendors, they're prepaying for insurance, internet. I don't know. They could be prepaying for a lot of things. And you wonder why they put it on the asset side. Well, the thing is this number then gets written off on the liability side, on the expense side, once this service is accrued. So once the month hits that they've prepaid rent for hits, then they take off, say it was like $10,000. Then this would go down to $152 million, or excuse me, it'd actually be less than that, far less than that. It'd be all the way down here is the 10,000 spot, and so that would get written off on the liability side, but I think you can kind of get the idea there. Typically, this is not something that, notice that it's been relatively stable here with Under Armour. They might prepay expenses for a number of different reasons, probably to save a little bit of money and for accounting purposes, but usually not something you're analyzing too closely. Next thing, we go into their property and equipment. We notice Under Armour has been acquiring different kind of property and equipment over the years. Just over the last year, they've gone from $478 million worth of this to over $751. And so they've accelerated their buying of this. Goodwill, in the case of Under Armour, is likely the excess purchase price that they've paid for some apps. They bought some apps a few years ago, and they had to write up, I think, over $500 million worth of goodwill. So that's the primary of this. It's usually in the case of an acquisition, and you not really overpay, but you pay more than what that asset is worth on paper, and so you usually recognize that value in goodwill. So Under Armour has quite a bit there. Intangible assets. These are things like things you can't touch, assets you can't touch. Under Armour, looks like it's come down a little bit, but that's fairly steady for them. Deferred income taxes, now we're getting into taxes and things like that. And other long-term assets, they have quite a few now, over $100 million worth of other long-term assets. So you can typically dig into this document and kind of find out what that is, or certainly call an investor relation guy, and he might give you a little bit more clarity of how they've gone from $66 million in other assets to 106. But certainly nothing to be too concerned about. As the asset line of Under Armour, as you can see, has grown since the beginning of the year and certainly has grown over last year. Now, the second part of the balance sheet, they don't call it balance sheet for nothing. Now we're looking at liabilities here. Current liabilities. They have a revolving line of credit. Typically, apparel companies are ordering and doing all kinds of, buying of inventory and shoes and, just one line of sneakers. Imagine all the sizes and the colors you need. And so typically Under Armour will borrow that type of money. And so we notice that there's that line of a credit. They have some accounts payable. So this is money, accounts receivable. This is money people owe Under Armour. Accounts payable is money Under Armour owes other vendors for whatever reason. And this is not alarming necessarily in Under Armour's case. You can see it's been steady here. But on smaller companies, you might see this number start ballooning, and that could be something you want to take further note of. Accrued expenses, I believe this is expenses they've accrued. Essentially, they're racking up some expenses that they're eventually going to have to pay there. Maturities on long-term debt. So this is money that I believe they owe on debt. So this is part of this revolving line of credit, revolves interest and other things. And so this is current maturities of long-term debt that is due. And other current liabilities, and you notice we have total liabilities down here. And in Under Armour's case, it has grown considerably over the beginning of the year, but compared to last year, it's in the same range. So you got to figure, all things being equal, Under Armour, everything's okay down here, at least on the surface level. Finally, we get down to the stockholders' equity, and we could have probably a whole show on this, especially in the case of Under Armour. They have three classes of shares. So they have this Class A, they have this Class B, and then they have this Class C. And I believe they've even changed it since the filing of this report. So this is, if I went into this, it'd be almost outdated for Under Armour, but they're giving you an idea of the stockholder equity here in these lines, different paid in capital, and we have some retained earnings that Under Armour's claiming here, well over 1 billion there. That's nice. And some accumulated losses. This is not a huge number for Under Armour, but definitely with smaller reporting companies that weren't profitable for a very long period of time, this could be a much larger number. And finally, we get down to the total stockholders equity line, 1.9 billion, and total liabilities included in there. You get this 3.68 billion. So essentially totaling up the balance sheet on that line. Next page typically takes you into what's known as statements of income or an income statement. And this is really I really like this. From a month-to-month view or a quarter-to-quarter view, you're taking a look at the company here. And typically what they do is exactly what Under Armour does here. They say 3 months ended through September 30th here. And so they have a 2016 here and they have 2015. So we can compare the 3 months ended. Now what Under Armour does here is they compare the last 9 months as well. So we have 2016 here and we have 2015 here. So I really like that. So we have Under Armour's business is really fairly simple. And so they have these net revenues. And so this is the revenue Under Armour brought in for the last 3 months. They brought in $1.4 billion in the most recent quarter. And you can compare that to the prior quarter here where they brought in $1.2 billion. Over the last 9 months, you've noticed they brought in $3.5 billion compared to we'll call it $2.8 billion. Now, cost of goods sold here, we notice that, for different companies like Under Armour, I would argue that they're dealing with prices of cotton and probably some other costs of these goods. But other than that, this number, as we can see, is ramping up fairly nicely and fairly steadily with sales. I've analyzed some other companies where sometimes this cost of goods sold elevates more rapidly than even the revenue coming in. That's obviously a huge red flag. But underneath that, we get this gross profit line. And with Under Armour, it's somewhat deceiving. I don't want to get too far into Under Armour's business model here, but gross profit just gives you one idea about how efficiently Under Armour is running their business. Now, $698 million worth of gross profit really looks great, but I'd argue Under Armour is a marketing company. Okay, they make something. They make T-shirts that can, you can buy a T-shirt for $2. The fact that Under Armour can put their logo on it and sell it for 20 or 30 or whatever they want to sell that T-shirt for, that's a marketing thing. That's a branding thing. And that's often included in this selling, general, and administration. Now, I'm going to show you this company over here. Just happens to be Fitbit, actually. So notice that this is their income statement, Fitbit's income statement. They actually break out research and development, sales and marketing, general administration. I just wanted to show you that Under Armour really consolidates it all into one. So the selling, general, and administration expense. They might break this out a little bit more in the future. But it is interesting that they consolidate it all here on one line. So we can see this is a huge number right here. Under Armour this $698 million worth of profit off, $1.4 billion worth of revenue really looked great until, oh, wait, we had to include selling, general, and administration and expenses, which is almost $500 million. And you definitely want to notice if this line is accelerating. Certainly with a company like Fitbit, you'll notice that look at their R&D expenses. It's like doubled over the year. In just their last 9 months, it has doubled. And this is almost doubled. And this is doubled. And so What you're hoping to see is revenue double, but notice with Fitbit, the revenue's not doubling. The revenue over here doesn't double, but notice that the expenses are doubling. I would call that a red flag. And if we brought up a chart of Fitbit at the current moment, their stock is near 52-week lows, which an all-time low, not just for a year, but their Fitbit stock is almost at an all-time low. And it's really because investors are looking at exactly this. They're looking at the revenues are going up, yes, but look how quickly these expenses are going up. Compare that to Under Armour, which stock is at near 52 weeks lows, but not at all-time lows. Under Armour has traded at lower levels back when it was a much younger company, but it's certainly at lower levels. We won't get too in depth on why, but I don't think the reason is these expenses are ramping up. You notice that these expenses are growing pretty quickly here for Under Armour, but they still are generating some net income. We notice that they have some interest expense, so this is some payments that Under Armour is paying on this debt. They have some other expenses here, fairly nominal here. And so this is income before income taxes. And now we know, Donald Trump is now the president of the United States, and he's prepared to make America great again for whatever it's worth. But one of his plans is to lower corporate income taxes. So income before income taxes, if this goes down to a rate of 10% or 15%, I can't remember what President Trump is trying to propose, but $190 million off $1.4 billion worth of revenue, honestly, is pretty solid for a quarter for an athletic apparel company. Provision for income taxes. So this must be money that Under Armour is setting aside for these income taxes. Now, obviously, if these income taxes change, this could go back onto the balance sheet as an asset, I assume. Finally, we get down to the nitty gritty. This is the number. They should put this in bold and increase the size of it. This is net income. This is the money that Under Armour earned off these sales. Let's take a look at just for comparison. This is Fitbit. Notice they had $503 million worth of sales here, and we come down to the net income line, and they earned a respectable amount of money. But you notice that Under Armour is clearing on $1.4 billion worth of sales. They're clearing this amount of net income, right here. So same number here. And now you notice that, again, these classes of share, a lot of companies have different classes of shares. You'll notice that Under Armour then breaks it down here. So Class A, Class C, and you notice they're giving you the income per share, and in Under Armour's case, it's all the same here, and I believe this is affected by some kind of dividend here. This dividend here is adjusting, and so that's why you have a difference in earnings per share here, but otherwise it's the same here, and this gives you an idea. It's not necessarily that big of a deal, but definitely something that you notice that we have noticed that Under Armour has increased the earning per share in the most recent quarter, and so that could be a good sign for them. This is the weighted average common shares outstanding. So this is the number of shares outstanding. This is certainly something. Let's see if Fitbit's on here. Fitbit does have the number of shares outstanding, and notice theirs is increasing. Notice they went from 206 million shares to 222, and notice over the last 9 months they've doubled the number of shares. So that certainly has affected the share price of Fitbit. When this elevates this quickly, there better be a lot of buyers of that stock. Otherwise, the price of the shares will go down. We notice that Under Armour has increased shares. Obviously, they've got to pay some of these executive and a lot of these employees with some kind of compensation. But this gives you an idea. Under Armour accelerating at a much slower rate. Fitbit, obviously, a much younger public company, but I just wanted to contrast that for you. Next thing we come on to is often with larger international companies, they'll give you this foreign currency adjustment. So that this all things being equal, from quarter to quarter, this obviously with the strong U.S. dollar right now, this is kind of a big deal, and definitely with a president that's could spark some international currency fluctuations just by some of the things he says. Certainly could come into play, but these companies, hedge all this stuff, and so they try to mitigate that risk. And I would say, all things being equal, these companies sometimes have quarters where these foreign currencies really benefit the company. Sometimes it really hurts them. I wouldn't invest in the short term or even the long term based on some kind of foreign currency thing going on with a company, especially a company like Under Armour. But definitely from month to month, it might, or quarter to quarter, or even year to year, it might create some buying opportunities or selling opportunities in the stock. But here's where you can kind of break it down. I don't typically worry about it as a buy and hold investor, but it's something you do want to be aware of in certain scenarios. Next thing, this is a statement of cash flows. So we pulled this net income number from up here. So we pull that down. Actually, they're pulling the 9-month number down. So they're pulling this 9-month net income number, and they're pulling it down here. So now we have 9 months ended, and we have the net income for the previous 9 months in 2015, and now we have the 9 months in 2016 right here. Now there's all this stuff that they're going to be either benefiting from, like it looks like they gain something from this currency exchange rates, and then there's some depreciation, there's income tax, there's stock-based compensation, there's inventories, there's account receivable, there's all this stuff. And then this is really giving you an idea of how the cash flowed through the business. And certainly a lot of investors really like to look, an income statement is great. It gives you this net income number, but this really, a net income can be mildly deceiving once you start looking into all these other expenses, and kind of gives you an idea how the cash flowed in and out of the business. So what I like to look at here is this net cash used in operating activity. So this gives you an idea of how much cash did Under Armour use operating its business. And you notice they have gotten a little bit more efficient here over the last year. And then cash flows from investing activities often come after that. And so we see purchase of property and equipment. We see purchase of property and equipment for related parties. Some different things going on here, but these are from different investing activities that Under Armour does, and it's showing you that how that cash flowed out of the business. Essentially, cash flows from financing activities is even more common. You'll see this on almost every company, especially ones with debt. But proceeds from long-term debt and revolving credit facility. So notice they say proceeds here. So this is money, $1.3 billion. It says proceeds. Now you might think, hey, this is great, but remember, this is debt. So this is a bank or somebody lending Under Armour this $1.3 billion. Now this is, since it's cash flow, we're talking about money that's come from a bank and it's flowed into Under Armour. And so that's why it's this positive $1.3 billion. And now we see a payment here on this debt. So Under Armour did make a payment, not necessarily on all this debt, but they made this payment of $889 million. Now we notice it's far in excess of last year. So the payments have gone up. So it's nice that Under Armour has met its obligation, but it might also mean that Under Armour certainly has been taking on a lot more debt obligations as well, which could be why the stock is also a little bit lower compared to where it's been in the past. Now, other things like cash dividends paid. This is where Under Armour, I think, just paid a one-time dividend. I don't believe they pay a regular dividend, or maybe only one class of their shares earns a dividend. But it gives you an idea. If you're, investing in a company like AT&T or Apple or Microsoft or any of these companies that pay a regular dividend, that would be kind of an interesting line as well. And finally gives you this net cash provided by financing activities. Now, this again, this is money that's come in via debt, and so this 460 million, it's yes, it's cash in the bank, but Under Armour will also have to meet this obligation at some point. So I just wanted to point that out. The last thing here is that this is a really cool line, especially with like a really young company or a company that has maybe a lot of expenses, really confusing balance sheet, and you just want to say, hey, what was the cash at the beginning of the period? What was the cash at the end of the period? And almost all companies have this cash and cash equivalents beginning of period, end of period. And so it just shows you here. So Under Armour had 129 million at the beginning of the period, and they ended the period with this amount of cash. And it all had to do with all these kind of financing and all this cash flow that came in and out of the business there. Next thing on a 10Q. Now, sometimes, again, with younger companies, it just kind of depends on the company. Sometimes this precedes what I just showed you. This sometimes precedes the balance sheet. This sometimes precedes the income statement. So it's kind of just, it's called a little bit of summary of presentation. Here on Under Armour, they're giving you an idea in this class. There are different classes of stock here. Next thing they go, shipping and handling costs. So I thought this was interesting. Under Armour puts that right on the top. So you can kind of see how much it costs Under Armour, over the last couple years to just ship things out. And so they're actually breaking out. Remember what I said that Under Armour kind of grouped all their costs all in one. And so you notice that shipping and handling costs, these costs are included within selling, general, and administration expenses. So that's what's cool about these 10Qs, because on the headline number, Under Armour is only going to give you this general and administration and selling line. But now you can come into these 10Qs and say, hey, well, this is how much was shipping and handling. So I think that was kind of interesting. Then you get some just legal mumbo jumbo, typically with some accounting standards and different kind of stuff like that. Long-term debt. Now this is a cool segment that I love to read. Under Armour, they got $1.4 billion worth of sales. I certainly expect them to have a revolving credit facility because they need to, order stuff from China. And they don't need to be fronting all that money in cash. They need that cash to pay employees or pay to keep the lights on. Once those items hit the shore in the U.S., Under Armour is expected to sell those goods through their distribution channels. And then once sales start rolling in, then they can start paying off this revolving credit facility. So Under Armour, I'd fully expect to have some debt. But in here, typically you can find the interest rates. And typically it refers to this LIBOR, which is London Interbank something rate. I can't remember what it's called. But it's basically, for a while there, I think this was like zero or something like that, or close to zero. And even right now, I don't think it's that high. And so you're typically, adjusting for rates off that. Just from scanning this, it looks like Under Armour has fairly good credit, just at least from what I'm seeing here. And certainly with the kind of sales that they have, it probably makes a lot of sense. I've looked into some other companies recently where they're borrowing at a 17-18% rate. Think about that. I mean, I have credit cards that are a lower interest rate than that. So if that should be really alarming. If you're looking into a company and you're thinking about investing in a company that can't borrow money for a lower rate than you can through an unsecured credit card, you should probably close the window and go find another investment. Here's a 3.25 senior note. So it's 3.25%. This is as low as a mortgage almost right now that's insured by the federal government. So that's, investors are really thinking that Under Armour's pretty safe bet here. And these are projected out all the way for 10, 15 years here. So, and other long-term debt. I mean, it's stretching out here for Under Armour, so they're building up a nice portfolio of debt here. But certainly with a company of this size, you typically expect that. Other things here, nothing too much, but some mumbo jumbo. Again, this is it looks like these are some of the marketable securities. It doesn't look like Under Armour's break this out. I think because it's such a small number, but it looks like there's some derivatives. This is some stuff that um, might be more something you look into for some other companies, but for Under Armour, these are fairly small numbers. Looks like they're just doing some small hedges and things like that. Stock-based compensation. So this is how the company typically rewards employees and certainly management almost all the time. So it gives you an idea about the kind of stock-based compensation you're doing, how much it is kind of in a fair value amount, and these amounts are in millions too. It's not $36. And so no, these might actually be in terms of the stock price, but sometimes you'll see fair values and things like that. Risk management and derivatives. Again, this is more currency exchange stuff. This is to protect the company against currency exchanges, or certainly the company collects currencies from around the world for all its goods, and so it has to do different kind of exchanges on that. And so this is kind of the math behind it. It's fairly small numbers. As Under Armour grows, certainly I know they're growing. We'll get into they're growing their international sales quite a bit. So these numbers definitely might become more significant for a company like that. Earnings per share. So we're coming down here to this line. Again, we're pulling in these net income numbers that we got from in there on the income statement. And now it's showing you the denominator, which is the number of shares outstanding. And so, again, I showed you Fitbit over here. They're growing their number of shares with rapid pace. Under Armour, not as much. And so you notice that could really change this earnings per share, this denominator. This is why companies buy back stock. They buy back these stock instead of having it go up in value. They have it go down. They reduce this number. So this net income number could go down, but if this goes down even more, then this earnings per share will go up. And foolish investors kind of look at the top line. Oh, they earned 29 cents per share, over 23%, 23 cents the year before. They must be doing better. Well, not necessarily. In the case of Under Armour, this is all fairly standard stuff. But, if they do a big buyback of shares, that's going to increase this earnings per share because the denominator, this weighted number of shares outstanding, would have gotten less. So just something you want to think about. Now, I mean, the really cool stuff about buybacks is if the companies keep growing this net income line and then they're buying back stock, then that is a positive buyback. And that's why, I'm not trying to make buybacks seem negative, but just to give you an idea of why a big reason why companies do that is to make this earnings per share number look even better, because that's the number Wall Street and everybody looks at. And if you can make this go up kind of artificially by making this number go down, you can certainly maybe get some keep the stock price up for a little while longer. Next thing, segment data. Now this is really important in 10Qs. This is the advantage 10Qs give you over 10Ks, which are the annual reports. Annual reports might have this on an annualized basis, but what I really like on a month-to-month or a quarter-to-quarter basis with companies, someone like Under Armour, you're really looking at, I think really it's this international expansion with Under Armour. We've noticed here net revenues in North America here, they're about the same over the last 3 months, even year over year. Yeah, it's changed here, 500 million. That's a lot. But it looks like to me these numbers are starting to reach scale for Under Armour. I don't want to say they're peaking, but Under Armour's reaching some scale here in North America sales. But we noticed these international sales, they went from 315 to 525. And so that's definitely a number that's growing. Look, over the last 3 months, just year over year, these numbers are really growing nicely for the international sales for Under Armour. And their connected fitness line, you notice that it is a very small part of the company here. Now, these are net revenues. Operating income or loss here, even more important. So we notice again up here, North America for Under Armour was increasing just a little bit, quarter over quarter and year over year here. Now, operating income. This is even more important. Notice that operating income for the United States is actually flat for the last 3 months. And notice that it's actually down for the last 9 months. So that is definitely something that investors are going to be looking at. Notice again that income, or the revenue that Under Armour is bringing in on the clothing line here in North America, it's gone up for the last 9 months. But notice the income that they've generated off those sales has actually gone down. And so they've become less efficient here in North America. Now, again, why I said the international expansion is it's kind of like virgin snow almost for Under Armour. Look at the operating expansion income that is expanded on the international side. So certainly something to be excited about. Now, if and when this international side starts to decelerate or peak or show signs of scaling and not accelerating like this for Under Armour, and who knows, that international stuff can come and go with a quickness. You can ask any company from Apple to Coach or anybody. This can come and go really quickly. And so it's nice that it's accelerating right here, but I think a cautious investor in Under Armour recognize, boy, this could go at any second, but it's certainly scaling up. We see the operating income internationally is scaling up nicely. How long that is sustainable, how long that lasts, who knows? But it's certainly making up for this a little bit of operational inefficiency we're seeing on the North American side. The connected fitness side, again, you'll see here in parentheses, this is because Under Armour is losing money on that segment of the business. They're losing a little bit less quarter over quarter, but they're certainly not generating any profits from there. Finally, we get down to this total operating income, and so this is kind of totaling all this up off these. So you can kind of get an idea here with the net revenues. Here's the total operating income. Now, another neat, we're in segment income here. Under Armour then breaks it down by apparel, footwear, accessories, which I think must be socks and backpacks and things like that probably. And so it gives you this total net sales. Then they have licensed revenue, which I think, I'm not 100% sure on this, but I think licensed revenue probably even says down in here. This might be stuff that they do for like UCLA or Notre Dame or something. That's probably a licensed revenue that they recognize there because they have to pay those companies royalties. Connected fitness, so this is the revenues that Under Armour is getting from their apps, and then it looks like they eliminated some segments here and they kind of credit it back up in there. So we notice apparel, again, is growing. Apparel's growing. Shoes growing. Accessories growing. License revenue growing. Connected fitness growing. Under Armour is growing, but what's kind of nice here is you can kind of then say, hey, is footwear really growing as fast as we need it to grow? Is apparel peaking? Is accessories peaking? These are all numbers. You can then go back to Under Armour's other 10Qs, and you can go back to however many you want and start comparing this year over year, month over month for however long you want, and that's what's pretty cool about that. Next thing, they tell you, hey, we're making a lot of statements here. These are forward-looking. We're not sure if they'll be true or not, and this is a lot of legal mumbo-jumbo. More overview. I think we saw this earlier, but with Under Armour, you're fairly certain on what's going on here. Results of operations. So we get the net revenues. Again, this is kind of consolidating some stuff we've seen over there. Also, they start putting some of this stuff in Word form. So we see these net revenues. These are all figures we've seen before. So, when you get into these 10Qs, and sometimes we're on our 16th page here, but they seem like they're really long documents. Understand that these companies, again, some of it is this legal mumbo jumbo you can kind of flip over. But then they start repeating this stuff that we've already seen. We've already seen net revenues. We've already seen cost of goods sold. We've already seen the gross profit. We've already seen the expenses. We've already seen the net income. They're just kind of consolidating it all here. Again, they do it here. Now they're showing it to you on a percentage basis. Now this is cool. I will say this is cool. I don't always see this. I think I see this a lot. Not always on every company is this clearly. So they're showing you this percent. I think the line that you really want to look at is these expense lines typically. So you notice that Under Armour's expenses, they've stayed fairly consistent over the last couple months. If we had gone down, I don't want to find it here on this 10Q and bore you with that. But again, we can kind of do the math here. Notice that the percentage of revenue with these expenses over here on this one is going up really fast, whereas Under Armour, it's staying about the same. And so that's definitely something you can draw a red flag from. Interest expense. Now, this is kind of a neat line where they show it to you in percentage. So we notice Under Armour has grown their debt and stuff like that, but it's still just 0.6 of revenues up here. And net income, we notice, is 4.4%. So they're essentially clearing kind of 4.4% down to this bottom line. So this is kind of cool. It shows you all these expenses as a percentage of the revenues. So you definitely can see certain trends and certain things kind of going up and down here. With Under Armour, you can see it's been fairly steady on almost all these lines. For the last 3 months and 9 months, it's been fairly steady for them. Consolidated results of operations. Again, we're getting down to, again, they showed us these apparel numbers, just a couple things. Now, what they're doing here is they're showing you this table up here, but then they come down here and they write this stuff out, and they sometimes give an explanation why, they use these terms, primarily driven by an increase in advertising, on higher sales, and they try to make things sound pretty good down here, but sometimes you can get on a company like Under Armour, typically this is broken out by an analyst, but on smaller companies, you're going to have to dig out, hey, why did apparel go from, this number to this number? On maybe a smaller company, you can come here and see why, what happened with the apparel sales. Maybe it was positive or negative. Sometimes the companies give you, it's typically only about one sentence down here, but it sometimes can give you a little insight. Same thing they're doing down here, but this is for 9 months. So they did the exact same thing that they did up there for 3 months, and now they're writing it out here down here for 9 months. Segment revenue, again, we're coming in with North America, International, and Connected Fitness. We've seen these figures before. They're just showing you to them again and then writing it down here. Why did Asia Pacific, the international, why was the international so good? And so they're telling you, specific regions within the international are performing or maybe not performing. So they're telling you that down here. So you get a little more detail down in this part of the 10Qs. That's why they call this the nitty-gritty. That's why they call this due diligence. And certainly Under Armour is fairly well-covered stock. Some of this due diligence is already out there in articles, but a lot of smaller companies, even something like Under Armour, this stuff's not always out there. Operating income, again, we've seen these numbers. Now they're giving it to you. Hey, why was operating income so efficient here? I'm sure they answer right here. They say increased liquidations. So, that's probably why North America is flat, kind of year over year, is because of this liquidation of increased liquidation of merchandise. Probably due to Sports Authority, maybe due to Under Armour, maybe not, having the right styles in the store. I don't know. Here it is for 9 months, same thing. They tell you, hey, seasonality, cold weather products, other types of things here. This is all a lot of, SEC kind of mumbo jumbo. Cash flows, again, we're seeing this is consolidated kind of table of cash flows. You got the operating activities, investing activity, financing activities, and then effects on exchange rate. And so here's a really nice clean net increase and decrease in cash and cash equivalents. So you see, hey, for the prior period, wow, Under Armour really had a decrease, but this time it's increased. But again, I showed you that this financing activity number, this $460 million line, this is money that Under Armour's got to pay back. So just because cash increased here doesn't necessarily mean that cash really increased. They have to pay this money back. Over here, cash decreasing might actually be good because they're paying some of this debt back. Just something you want to keep an eye on. More text here. If you want to come in here and read this stuff out, they're telling you again, we went over these 3.25 senior notes. I don't know why they have to repeat this, but I'm sure it's just legal mumbo jumbo, or the certain section it has to be in. Getting down further into risk factors, this is something you want to, again, they tell you the risk factors is included in our annual report 10K. So sometimes when there's like an update to these, or I've seen them in 10Qs for some companies, maybe it's for younger companies, but risk factors certainly something you want to read before you invest in any company. Go to the 10K, but they tell you to go there here, so I kind of like that. Other information, they might throw some. Looks like they threw a guy 500,000, and then we finally get down to signatures, guys. Mr. Kevin Plank, electronic signature. So there you go, guys. Now you know how to read a 10Q. Look how many pages you just went through. Thanks to Under Armour. And you could certainly compare this to other apparel companies, certainly any device manufacturer, any manufacturer of any goods. This 10Q will certainly help you out. So check out our other videos. Thanks for checking us out. Hope you enjoyed it. Subscribe, like, comment. See you later.